Welcome back to the Deep Dive. We're doing something a little different today. Usually we're looking at, broad industry trends, but today we are getting tactical.
Very tactical. We're zeroing in on one of the toughest sections of the syllabus.
Exactly. It's the section that consistently trips people up. We are cracking open the Accounting for Equity Compensation 20th edition, the 2024 update, and dive straight into Chapter 4, Measurement of Expense.
This is the heavy lifting. It's the math, the models. It's really the bedrock of everything. It requires a mental shift,
A shift how?
Well, you have to start thinking about stock options as just a perk, an HR thing. You have to start seeing them for what they are, a financial derivative that needs a price tag.
And that's the whole challenge, right? If I buy a share of stock, the price is right there on my screen. But an employee stock option to buy that same stock in 5 years, that price doesn't exist anywhere.
You have to manufacture it. You have to estimate what a rational third-party investor would pay for it. That's fair value.
And before we get into the battle of the models, Black-Scholes versus lattice, I really want to ground this whole thing in the idea of time value. The book uses this car loan analogy that I thought was just brilliant.
Oh, yeah, that's a classic. It's a great way to frame it.
So, okay, imagine a car dealer gives you a choice. You can pay $30,000 cash for a car today, or you can pay that exact same $30,000 in 1 year, 0% interest.
Rationally, you never pay today.
Never. Because that 30 grand has potential. You keep it in the bank for a year, and even with a tiny interest rate, you've made money. The book says, what, maybe $200?
Right. So the value of waiting, the time value is $200. You'd actually be losing money by paying upfront.
Now apply that to a stock option. You have the right to buy stocks at a fixed price, but you don't have to spend a dime for years. You get all the potential upside while your cash is still working for you somewhere else.
That delay has real tangible value, and that's the whole point. When we talk about an option's fair value, we're not just talking about the spread between the grant price and the stock price.
In fact, most options are granted at the money, so the spread is zero.
Exactly. The intrinsic value is nothing at grant. Its entire value is that time value. It's the value of that ticket to potentially capture future growth.
Okay, so that brings us to the tools we use to price that ticket, the models. In this corner, the reigning champion, Black-Scholes Merton.
The industry standard. Developed in the 70s, won a Nobel Prize. It's this elegant, self-contained formula. You plug in 6 inputs, and bam, it spits out a single number.
Fast, efficient. But the text points out a huge flaw, at least when it comes to employee options. It wasn't built for us.
No, it was designed for so-called European options, which can only be exercised on the very last day of their term. They're rigid.
But employees are not rigid. We're chaotic. We exercise when the stock jumps, or when we need a down payment, or when we quit. We almost never hold on for the full 10 years.
And that creates a massive mismatch. If you plug the full 10-year contractual term into Black-Scholes, it's going to assume you have to hold it that long.
And it'll overvalue the option.
Wildly. So the accounting world came up with a workaround, a kind of hack, the expected term.
So instead of the full 10 years, we just guess. We guess how long the employee will actually hold it. Maybe 5 years, 6.5.
It's an estimate, yeah. It's an attempt to shorten that time input to account for real-world human behavior. It's a bit like, shaving the corners off a square peg to fit it into a round hole.
But it lets companies keep using the simpler formula.
It does. It's standard practice.
Now, compare that to the challenger, lattice models. The book describes this as being more like a simulation.
Think of it like a decision tree, a multiverse of possibilities. It breaks the option's life into thousands of little steps. At each step, the stock can go up or down. And at each node, the model asks a question.
Would the employee exercise right now?
Precisely. You actually input something called a suboptimal exercise factor. You tell the model, my employees tend to cash out when the stock is, say, 50% above the exercise price. The model then runs that logic across all those thousands of paths.
That sounds infinitely more accurate.
It's more flexible, for sure. It can handle things like changing volatility over time. The international standard, IFRS 2, actually prefers it.
So why do most U.S. companies still stick with Black-Scholes? Is it just easier?
It's easier, and it's a data problem. To run a lattice model well, you need really robust historical data on exactly when your employees exercise. If you don't have that, the model is just guessing. Black-Scholes is a blunter instrument, but it's often easier to defend to an auditor.
Speaking of auditors, let's talk about the ingredients for these models. Section 4.3, Valuation Assumptions. We touched on expected term, but I want to ask about the simplified method. That sounds like a get-out-of-jail-free card.
It's a temporary one. The SEC knew that newly public companies just don't have the data, so they allow a formula. You just average the vesting term and the contractual term.
So a 4-year vest and a 10-year term.
Yeah.
Just becomes 7 years.
Yep. 4 plus 10, too. But, and the text is very clear on this, it's only for companies with insufficient data. You can't be a huge established company and use this just because you like the number it gives you.
Okay, let's move to the most controversial input. Expected volatility. This always feels backwards to me. In real life, volatility is bad, it's risk. But in option pricing, more volatility means more value.
It all comes back to the asymmetry of the option. If you own the stock and it crashes, you lose your shirt. But if you own an option and the stock crashes...
You just don't exercise. Your downside is capped at 0.
But your upside is unlimited. So high volatility just means a wider range of possible outcomes. It increases the chance of a moonshot scenario. And since you don't care about the crash, you only care about the moonshot, a more volatile stock makes for a more valuable option.
So companies are in a weird spot. They want to tell auditors their stock is stable to keep the expense down, but the market might see it differently.
That tension is very real. The text lays out the main ways to calculate it. First is historical volatility. You just look backwards. If your expected term is 6 years, you look at the last 6 years of your stock's price movements.
But the past isn't always prologue.
Exactly, which is where implied volatility comes in.
Yeah.
If your company has options that are publicly traded on an exchange, you can look at their prices. Those prices imply what the market thinks future volatility will be.
And the rules prefer a blend of those two, right?
Generally, yes. You can't just ignore what the market is telling you.
Okay, running through the others quickly. Risk-free rate and dividends. These feel a little more straightforward. Higher interest rates are good for the option holder.
Yes, it goes back to that car loan. If interest rates are high, the value of keeping your cash in the bank instead of using it to buy the stock is higher. So the option to wait is more valuable.
And dividends are the opposite.
Right. A dividend payment usually causes the stock price to drop. The option holder doesn't get the dividend check, but they do suffer from the price drop. So higher dividends mean a lower option value.
Got it. Now, what about transferability? Most employee options are stuck with the employee. But what if you could sell it?
Oh, that changes everything. If an option is broadly transferable, meaning you could sell it to, say, a hedge fund, the valuation method flips. You stop using the expected term.
And you use?
The full contractual term, the full 10 years.
Why? Just because the owner's different?
Because a hedge fund is a perfectly rational economic actor. They aren't going to quit. They don't need cash for a house. They will hold that option until the very last second to squeeze every last drop of time value out of it.
So the term jumps from 6 years to 10, and the expense would just skyrocket.
Which is exactly why you almost never see them. The accounting cost is just too high.
Let's pivot to full value awards, RSUs. This seems like the easy part of the chapter.
It usually is. The fair value is just the stock price on the grant date. No models, no fuss.
Unless there's a dividend wrinkle.
That's the one catch. If the company pays a dividend, but the RSU holder doesn't receive it while they're vesting, that RSU is technically worth less than a real share of stock. You have to subtract the present value of those dividends you're missing out on.
Okay, now for the really tricky stuff. The exam killers. Section 4.6, special conditions. Let's start with market conditions.
This is the classic distinction. Vesting if revenue hits $10 million is a performance condition. Vesting if the stock price hits $50 is a market condition.
And the accounting is completely different.
Night and day. For a market condition, you can't use Black-Scholes. You have to use a much more complex model, usually a Monte Carlo simulation.
So what is Monte Carlo actually doing, in simple terms?
It's running like 100,000 simulations of your stock price. In some of those simulations, the stock takes a random path and hits $50. In others, it doesn't. The model counts the successes and failures to figure out the probability-weighted value of the award on day one.
So the chance of failure is baked right into the grant date value.
Exactly. And that leads to the biggest trap on the entire exam.
The phantom expense.
That's it. You book the expense based on that Monte Carlo value. Now let's say the vesting period ends and the stock never hit the target. The employee gets nothing. Zero. But the company
cannot reverse the expense.
Cannot reverse a penny of it.
Yeah.
The logic is that you paid the employee with an opportunity, with a lottery ticket. The fact that the ticket wasn't a winner doesn't mean the ticket was free.
Wow. But with a performance condition, if you miss the revenue target, you reverse the whole expense.
back to zero. That distinction market versus performance and the reversal rule is practically guaranteed to be a question.
Last one, spring loading. The SEC has been all over this.
This is when a company times a grant right before releasing good news. The stock is at 20, but the execs know they're about to announce something that'll send it to 30.
So they grant options with a low $20 strike price.
Right. But the SEC's issue isn't just the strike price, it's the valuation for the expense. Black-Scholes assumes the current price reflects all public information, but in this case, it doesn't. There's material non-public information.
So you can't just plug in $20 and call it a day.
No. SAB 120 says you have to adjust your inputs. You have to value the option as if that good news was already public, or significantly increase your volatility input. You can't pretend you don't know what you know to get a lower expense.
Okay, we have covered a ton of ground. I think we're ready for the bear trap check. Instead of a quiz, let's hit the two areas where people consistently get this stuff wrong. Trap number 1.
Confusing how expected term works in the two main models? So remember, in Black-Scholes, expected term is an input. You estimate it, you plug it in. In a lattice model, expected term is an output. The model calculates it for you based on the behaviors you programmed into it.
Crucial distinction. Okay, trap number 2.
The reversal trap. Just to hammer it home. An employee quits. You reverse the expense. They miss a performance goal. You reverse the expense. But if the award has a market condition and the stock target isn't met?
You never reverse the expense. Don't let them trick you.
Never.
I want to leave everyone with one final thought I found on the text. We spent all this time, all this energy on these complex models to get the fair value for our financial statements. But when the time comes for the company to take a tax deduction,
it's a completely different number. The tax deduction isn't based on the Monte Carlo model. It's based on the actual intrinsic value at exercise, the real cash spread.
So the book expense is this theoretical modeled number from grant date, but the tax deduction is based on actual market reality years later.
And they almost never match. That disconnect is what creates deferred tax assets and a huge amount of work for accountants. We're keeping two different sets of books based on two different versions of reality.
Which is probably why job security in this field is so high. All right, that's chapter 4. It's technical, it's dense, but it is absolutely conquerable. Go back, reread that section on market conditions, and you'll be fine.
Good luck with the exam prep.
See you on the next deep dive.